I've made loads of mistakes as I got started investing and many more even years afterwards. They've cost me a huge amount of money, but there's no reason they should cost you. So here's 5 things you need to know before you start and some tips no matter how long you've been investing for. Oh, and some of these are not quite as obvious as you might expect. Okay, this first point is one that I've covered many times before and I'm not going to stop repeating it until most people in the UK understand what this means. When you invest, it's really important to make sure that you know what type of account you should be using. This is so important for a number of reasons, and it could be the difference between having a huge tax bill to pay or even not being able to access your money for decades. So the best general advice I can say here is that you should take the time to learn about the different types of investing accounts before you get started. In short, you've got pension accounts, ISAs, and general accounts. There's a lot more devil in the details, and I have covered a lot of this already on my channel. So for example, I've got a really simple guide for stocks and shares ISAs, which has had more than 150,000 views that you're welcome to watch after this one. If it helps, I like to imagine the account types as different buckets, especially like the cheap ones you can get from B&Q, those orange cheap ones. Now, just picture them all the same size. However, they've all got little details, if you look a bit closer, that makes them a little bit different. So for example, one has a lid on it with a padlock with a timer on it that will only unlock at a certain age, pretty much just like how a pension account might work. Another bucket has a lid with no lock that lets you take things in and out. However, anything that goes in gets added up on a little counter on the side. So that's pretty much like an ISA. And then the final bucket would have no limits and just be a plain one, except a little sticker on the side saying, warning, tax might be due, which is like a general investing account. Before you get started doing any investing and even thinking about what things you might want to invest in, I really think it's worth spending the time learning the basics of investing accounts, especially the stocks and shares ISA, as there's no tax to pay on anything you can make, and you can freely take money in and out as you buy and sell your investments. The fact that most people still aren't using one is something we've got to change in the UK, so feel free to watch my video before you invest your first money. Okay, this next one is a trap that I think everyone will fall into at some point on their investing journey. I've fallen into it and I still get the same questions in my comments all the time. Things like, is this a good time to invest now? Or maybe someone saying, I'm holding all my money in cash at the moment, waiting for the market to crash before I put anything back in. Let's just get this straight from the beginning. There is nobody that can predict the movement of the market in any kind of reliable or consistent way. If there was, that person would easily become the richest person in the world, as they could just jump in and out, buying right at the bottom and selling right at the top. Plenty of people will claim to know what's going to happen next, and there are lots of people who are totally convinced that they're just better at predicting the future than others. Yet time and time again, we get reminded just how impossible it is when events come out of nowhere that nobody predicted at all. I think the most difficult thing here is starting to invest when the stock market is at all-time highs or very close to it. It's really easy to fall into the trap where you assume it can't go any higher and that you've completely missed out. It makes sense to yourself that you should just wait for a pullback or crash because there's always loads of people who say that a crash is just around the corner. You do the same with an expensive purchase. I know I do at least. If I know that something often goes on sale, then I'll just wait for it to go for a lower price as nobody wants to pay the full retail amount. Well, investing is not quite as simple as that. Now, let me show you something that might make you less nervous about getting started. Since 1950, the S&P 500, which we can use as a benchmark as the stock market, has hit new all-time highs more than 1,250 times. And this data is a little bit old as well. Now, over some years, it might not hit any new highs if the market crashes, but in other years, it can hit new ones almost every week. For example, in the 2010s, the market hit 242 new all-time highs. So if you work that out, that means that every 2 weeks, on average, the market was hitting new all-time highs. Imagine you're a new investor starting during that time. You keep seeing these highs and you think you better hold off and you just wait for a crash, just like the one that happened during the global financial crash. Surely, all you need to do is keep saving your money up and then just buy everything when the market's on sale. It sounds logical and sounds simple to do, but in practice, it just does not work like that. Remember, if it was that easy, we'd all be doing it, including the professionals. Let me show you something that might surprise you. If you only invested during all-time high periods, the returns you get are actually very good. This is like saying, imagine you're the investor with the worst luck possible, because as always, it's got to be you. According to that data, investing over 1, 3, and 5 year time periods during only all-time highs, your returns were actually very good when you compare it to the market in general and you look at the average returns. This dark blue bar represents the person investing at all-time high, so the person with terrible luck, which is probably going to be you. And this yellow bar shows the market average during the same period of time. As you can see, the difference between the two is really not as bad as you might have expected, and it's a really good reminder that just because the market might have hit an all-time high, doesn't mean that we're somehow due a crash straight after. I'd argue that all-time highs are just part of investing, and we should really just all get used to them. Now, I bet if you're anything like me, you assume that to be a good investor, you had to know loads about the stock market, and especially lots about individual companies. I mean, I know I did, and I assumed that the best investors were the ones who picked the right companies. I just thought that the more work you put in, the better your results has to be. And this is what usually happens to everything else in life. However, word of warning, this is not how investing works, and there is absolutely nothing certain about the future, or any way at all to be able to predict where the share price of a company is going to be next week, next year, or 10 years from now. Most professional investors are not able to beat the returns of the market average, even with all of their resources and highly educated analysts. Again, if it was all that easy and so predictable, then everyone would do it. Here's the trap that I wanted to point out. Now, at the moment, the stock market is doing pretty well, but not only that, there are loads of companies that are making some huge gains. Some of these companies' share prices are up 300, 400, or even 500% in just the last 12 months. Now, lots of people are seeing these gains and then buying up those companies because they also want to make a lot of money and don't want to get left behind. However, I think this could be one of the biggest traps of them all. If you buy a share of a company because it's gone up a lot and it's the next big thing and everyone is saying that it's a no-brainer, I think you could end up getting yourself into a lot of trouble. Now, you could do just fine. I'm not here to rain on your parade, but I do just want to remind you just how risky any individual company can be. Also, no matter how good a stock has performed over the last year or the past few years, this gives us absolutely no more clue as to how it will perform in the future. It's very possible that even if a company does well and continues to succeed, its share price could still fall or might not move at all when you end up buying it. I think this is the part where people end up getting very disappointed with investing, especially if they start to invest in a company that's done well and been on a big run. They put their money in and then they expect that in just a few months or a year later, they're going to magically double or triple their money. Now, it's totally possible for a company to do that. However, over the long run, very few companies ever deliver huge returns to their shareholders. And a really key point I wanted to make here is this one. A stock price can easily go back down just as fast as it went up. Your investing portfolio can go from being a millionaire to break even very quickly. Just imagine this if it helps. Before the dot-com bubble, can you imagine how many investors were looking at their accounts with huge, massive gains thinking that they'd somehow cracked the code, or that they were now millionaires so life was complete? All they were looking at was a price on paper. It's not real money until you actually sell an investment. And this is the same today as it was back then. Anytime you see someone else showing off their gains, remember that it's not a profit until you sell, and all you're looking at is the price that the market is right now. Tomorrow, next week, or in the next few years, that price can and will change. Where it changes to, nobody knows. So just be careful with any individual stocks. If you want a solution to this, index funds are your friends, and I've done loads of videos on my channel about that. This next point will always be such an important one for me. When I started, I had no idea what the costs were when it came to my investments. I just assumed that if I opened up an account with one of the big named investing companies, the fees would all be competitive enough and the little charges wouldn't really amount to much. Kind of like going to a big supermarket. I thought I'd get a good deal no matter who I went to. Boy, was I wrong here, and thankfully I've managed to now get my investing in a place where my fees are either zero or very, very low. The thing with fees and charges in the investing world is that there's just so many of them, and the worst thing about a lot of them is that they can have a huge impact on what you could end up with. This is because any money taken out by fees is gone forever from your investing returns, and even small numbers can have a big impact. But let me show you a very quick example. Let's say that we want to invest £200 a month, and we do this for a period of 25 years. If we get an average return of 10%, just to keep things simple, we could end up with an account with just over £250,000. Now, that's a pretty nice amount of money, and the best part is that more than £190,000 of it would be from the investment return. Now, let's compare that to someone else who has to pay 1% in fees every year. So instead of getting a 10% return, they now get an average return of 9%. Let me show you just how much of an impact this can have and why keeping fees and charges low is so very important. The person paying those 1% in fees ends up with £214,916. That's £35,000 less, which works out to be about 14% over that time period. Imagine that, they both invested in exactly the same thing, put the same money in every month, but all they did differently was one person used an expensive investing platform and another person used a free or low-cost one. Now, there's loads of detail I could go into when it comes to fees and charges, and I've done videos before going over these. And as an added bonus, I've also done a video on the best stocks and shares ISA providers, where I talk about who's got the lowest fees and which platforms I like the most. For example, Trading 212, who I use for my stocks and shares ISA, has almost no fees at all. There's no fee to open an account, no trading fees, and no ongoing account fees to manage your account. If you do want to get yourself started investing with them, you can get a free fractional share worth up to £100 if you open an account and deposit at least £1. All you need to do is follow the link below or use the code Toby in the promo code section once you've got it installed. Here's my final point I wanted to make in this video. Investing, especially long-term investing, over many years and decades is not an easy thing to do. It's not because it's particularly difficult to set up. In fact, it's easier today than it's ever been to get started investing. The challenge all comes back to the face that you see in the mirror every day and what goes on between those two ears. Some of the basics of investing sound really easy. You just invest what you can afford every time you get paid, keep doing that for years and years, you stay well diversified, and with a bit of luck, you'll end up with a really nice sized investment. This all sounds great, but most of us out there will get distracted at some point, will give up and get frustrated about how things are going. Before we know it, we're no longer investing and we're back at our old habits, trying to work out what to do with our money. Or worse, we're taking some much bigger risks in some new type of investment that your mate is claiming is going to make everyone rich. Investing for the long term is not easy at all, but if you know that from the start, here's how I think you can end up helping yourself. Now, I do the following things. I automate my investing each month, so when I get paid, so I don't have to make manual choices about what to invest in or how much to put in. I commit to myself that investing is just like paying any other bill in my life, like my mortgage or my council tax. This helps avoid the temptation of not investing at all or trying to time the market because somehow I'm worried that the market is at all-time highs. Secondly, I stay well diversified so that in the event of a market crash or even if a whole industry is going through troubles, I'm well protected. It doesn't mean that on paper I can't lose money or see a big red number in my account, but it does mean that all of my eggs aren't in one basket or one single company, which could easily end up on the scrap heap. I do this by mainly using index funds, something I think is well worth getting yourself educated on. And finally, I remind myself all the time that booms and busts are all just part of the market. All-time highs, stock market crashes, unexpected news and black swan events are all part of this thing. What separates good investors from bad ones is not reacting every single time the latest news story or a warning from a grey-haired old man telling you to buy gold and hide in your basement. If you can stick with investing for the long term, I think it's pretty much like a superpower. The market can act so crazy in the short term and any given day can create a huge amount of chaos. But over time, if you zoom out and focus on what you can actually control, I think you'll probably do much better than even the professionals, but nothing is ever guaranteed. Good luck with that. And if you need some more pointers on how to actually get started investing, feel free to follow my Investing for Beginners guide here, or you can check out my Best Stocks and Shares ISA guide on the other side of the screen. I'll see you in the next video. And as always, happy investing.